Oil prices remained near 5-week highs, fueled by talk of producers taking action to prop up the market, as it were. Now, these gains are driven by expectations from investors that oil producers may take action, possibly freezing output in order to rein in oversupply. Led by the top exporter of that particular commodity, Saudi Arabia, the Organization of Petroleum Exporting Countries has restarted a debate about oil producers potentially capping output in an effort to reduce a global overhang in production. Many traders, however, are skeptical. They keep voicing their doubts about OPEC's ability to agree, especially given how divided the organization has become. Analysts also said that concerns about oil production in Venezuela were backing higher markets. Venezuela is on track to suffer its steepest annual oil output drop in 14 years as it continues to struggle with an economic and political crisis. Let's head over live to Washington. Daniel Ranges has been following this story in detail. He joins us now live from Washington, D.C. Daniel, the last time we had this discussion was way back in April. Is September's meeting on the sidelines of the International Energy Forum in Algeria likely to be any different, or should we just expect the same tragic comedy that played out in April?
Well, Rama, as you know, Iran has been the major holdout in the OPEC countries agreeing to some kind of cap or even production cuts. The reason for that is because they were under sanctions for so many years and they feel it's their right to get oil production up to levels that they deem comfortable for them, and then maybe they'll be willing to make a deal. That current level that they've expressed is 4 to 4.2 million barrels per day. But for the last 3 months, they've been around 3.5 or 3.6 million barrels a day. They've sort of plateaued. So on the criteria that Iran use, a deal is not on the table. Will they decide that actually 3.6 million barrels a day is a level that they would now be comfortable in, is a decision for the policymakers of OPEC and particularly of Iran. Some optimism might be that, essentially now it's in the interest of these countries to cut production because it would definitely have a major effect on the price of oil going forward in global markets.
Indeed. Let's talk about the Baker Hughes rig count. It's been rising for several weeks in a row now. Is that conclusive, definitive proof that the Saudi strategy of trying to flood US shale producers out of the market has, at face value, completely failed?
Well, this rig count that you mentioned is the sort of US and North American national count of rigs that are currently in operation. And yes, in the last few months, they've ticked up a little bit, but mainly in one area, the Permian Basin, which is in West Texas and parts of New Mexico. And the reason for that is because the oil is so cheap to get out of the ground, so it's economically viable. But for most production in the US, people have still shied away. And if you look at the year-on-year results, a year ago, we had about 1,095 oil rigs in production. Now we have 586. So it's almost halved in that period. So it does give you some sense of where we're at. That being said, the efficiency of the US production has increased. 2014, it cost on average about $44 a barrel to get oil out of the ground. 2015, $36 a barrel. 2016, who knows how much more efficient they'll be. So I think there's likely to be a bit of a period of waiting for American producers. And in fact, in the last few hours, I spoke to a prominent oil billionaire here in the United States, a big investor who I spoke to on condition of anonymity to get more information out of him, to be frank. And he said a lot of these producers are waiting to see how the oil price goes because they don't want to break even. They want to make serious money. They think, or he thinks, that the oil price will tick up based on the pressure on OPEC at this time. And then all these American producers will again consider jumping back in.
One last question for you, Daniel. We've seen a decline in shale output in aggregate, but we've also seen, as you just mentioned, a decline in the number of active rigs. Given those two numbers, how concerned are investors about corporate debt levels in that sector and the risk of default?
Well, I've taken a look at the numbers. Fitch provides a very good rundown. They suggest that in the last year there have been about $45 billion of oil defaults in various forms, various bankruptcies, bad debt, and all kinds of different ways that they negotiate that. There may be some additional defaults or additional level of defaults going forward. Certainly, I think that is to be expected. But, you know, this is the overhang of people who put their eggs in $100 a barrel basket. That is only a transient thing. It's part of a normal cycle where some people, some investors, particularly bondholders, got a little bit overexcited about the prospect of oil staying high. Those impacts, I think, will begin to decline over time, especially if the oil price picks up as it has in the last few weeks.
Indeed, we'll leave it there for the time being. Thank you for that. That's Daniel Ranges live, of course, in Washington. He's been keeping tabs on developments, of course, in the US oil sector and keeping us updated.